Welcome to International Securities Exchange's podcast series.
Now, but this gets back to one of my original points that I made when we looked at the euro, and that was how much are we at risk? And with options, one of the advantages that we deal with here is that because we're long the option, it's not the same as being long the underlying currency pair if you're trading with your dealer. When you're trading currencies with a dealer or even in the futures market, you have unlimited risk whether you're long or short. When you're long an option, your risk is limited to the amount you spent. So I've got a follow-up question here from Ron saying, can I explain the up and down barriers? I can, really easy. Here's what you do. You take the strike price, which is 88 for both of these options, the 88 put, the 88 call, and you add the total amount you spent on this particular trade. So 380. So this cost me 380 to get into the trade, hypothetically, and I add that to 88. That gives me my upper barrier. So at about, let's see, 92.80 or so, and I subtract it from 88 to get my lower barrier, which is what, about 84.20. So if at expiration the market is beyond either of these two prices, then that's where I'm accumulating profit. Now, it is possible that if the market moves a lot in the very short term, I could be profitable way before I get to these barriers too. It's convenient to be able to talk about it at expiration because it makes the math a little bit easier, Ron. Okay. So, and by the way, I mean, this is, if something here is kind of striking your interest and you're like, well, this kind of makes sense. Maybe, so I'm a Forex trader, maybe I should mirror some of my trades. So I'm going to do one last really quick example. We've got the Aussie dollar here. And by the way, if you wanted to trade this as an option, the symbol is AUM if you want it priced like it is in the Forex, with the Australian dollar first and the dollar second. So meaning that it's basically priced in dollars. So right now it costs 90 cents to buy an Australian dollar. So 90 cents US to buy $1 Australian. We're bumping up against a fairly firm resistance level. And if we were tempted to take a trade to the downside, we could do, we might even be able to do a little bit of both. So here's a for instance. What if we were to short the Australian dollar in a Forex account, okay? So we short the Australian dollar, and maybe we're targeting 87 to the downside in the very short term. So we think that a big move is coming to the downside, a bounce off of resistance in the next week and a half. The market gets all the way down to 87, and and we could, so if in fact it played out, so we got in at, let's say, 90, and it got all the way down to 87, we could have profited 300 pips, which in a single mini contract, that's like $300 worth of profit. But if we put a stop loss on that trade, especially if the market moves down quite quickly, we could find ourselves in a situation where we're getting stopped out on these big shadows. I mean, here's an example. Back on the 15th of July, the market opened at 88.48. It hit a low of 87.31. So that's over 100 pips worth of volatility just in that shadow that occurred back here on the 15th. How many times have you gotten stopped out on shadows, right? So rather than applying a stop, maybe what we do is we buy a call option, because the call option acts as our hedge. It acts as our stop loss in a way, because if we bought a call option, let's say it's the 90 strike price, and we don't need to buy a whole lot of time, so we're not overly worried about it, and so maybe we spend $1 on that, or $100 to buy that particular hedge that expires in August. Well, if the market did, in fact, all of a sudden rise, in the very short term. So let's say in the short term, the market popped up a lot, and we've now accumulated some losses on our long position in the Forex. So the market didn't go down; it in fact went up, and let's say we're down $100 on that Forex position. So we're down 100 pips. Well, we had a call in play that has been gaining in value during that time period. So maybe it's just in the last 3 days, the last 4 days, or whatever. The market popped up. It was unexpected. We didn't have a stop loss on it, and so we're down 100 pips or $100 worth on that particular trade. But we have this call in play that has a short-term expiration, didn't cost us a lot to get in, and it's up, maybe it's up 60 cents. So I'm making a few estimates here. The way that you can really visualize this is if you're a Forex trader and you're evaluating a trade like this short one that I'm analyzing here on the dollar, on the Australian dollar, you can say, okay, well, let me set this up and let me just watch it over the next couple of days. What if the market did pop up 100 pips? And now all of a sudden, so I'm down 100 pips on my Forex trade, but I'm up about 60 cents or the equivalent of 60 pips on my option trade. So now instead of being down a full 100, I'm actually only down 30. So I've made my trade a lot more efficient. And the way you can really visualize this is enter a couple of examples. So mixing and matching across markets, to me, it makes a lot of sense. It's not just a question of, do I short the Australian US dollar or do I buy a put? I mean, that's one of the contrasts we could make. We could try to decide between that, but we could also say, no, I'm going to do a little bit of both. I'm going to short the Australian US dollar because I like the unlimited upside or the unlimited profit opportunity to the downside here in my Forex account, but I'm also going to buy a call that will gain in value in case this trade goes against me, and it'll help offset those losses. So, and in fact, it could offset a lot of them, especially in the short term, without losing all of its intrinsic or time value. So I've thrown out several ideas here, all of which are easy to paper trade and get a better feel for yourself. But if you're a Forex trader and you're not real experienced in the options market, I would throw you over to, there's a lot of educational resources that you can use to try to get up to speed. Steve mentioned one of them as we were just starting the presentation. You can also come to our site. We do trading examples all the time. We have a lot of free education about options themselves. It's all free. You can watch videos and paper trade it as you kind of go along, get a feel for it. And similarly, for those of you who've been trading options forever and you understand the strategies I'm talking about, but you're not really clear on how to analyze an opportunity in the Forex market. So what fundamentals matter? How do technicals work? Are they any different? Are there any complexities I need to worry about with a 24-hour market? Come check us out. Every day we do a live webinar on Forex trading. We've got a huge section of Forex trading videos to give you an idea as to, all right, so what are the fundamentals of the Forex? How does it work and why? And what are the differences? So there are ways to get caught up or get up to speed on how it works if you're familiar with one side but maybe not as familiar with the other side of the market. Okay, so let me turn it over to a little Q&A here. Let's see. I'm looking at both the questions box as well as the chat box. Looks like I hit most of the questions. Steve, have you seen anything that I didn't get a chance to?
I don't think so, although let's give everyone a couple of moments. John, would you mind talking about your site, the times, and everything there? It's so impressive that it's all free. Can you just go through a little bit about your site?
You bet. You bet. In fact, let me do this. I'm gonna bring it up in a web browser just so everybody sees where it is and how to get there. See if I can get it to go here in WebEx. So first of all, here's the URL. All you have to do is go to learningmarkets.com. That'll get you right there. And right from the home page, we have basically a streaming series of current articles. We do 2 live events per day. The first one we do before the New York Forex section starts and before the market session opens. That you can register for. It's free. We run it just like this, like these webinars. And then we do one after the stock market closes on where we take a look at most of the markets, but we do kind of a special concentration on options and stocks in general. So both of those are you can register for them at any time. And across the top, we've got a series of tabs where you can kind of dig in by topic. So if you're really interested in the Forex, you can click on the Forex tab, and it will take you right through to a whole series of articles on that.
please visit www.ise.com/podcasts.